To another episode of Beating Alpha. This is episode 65, and we have a very special guest that I'm very excited to be talking with, as you see here on the screen. His name is Anthony Scandariato. So he graduated from Cornell University with a bachelor's degree in applied economics and management. He was also a co-founder in Ridgeview Partners. He specialized in retail space with a vertical model that provided flexibility to serve multiple customer segments with similar product lines through retail, wholesale, and production contracting channels. He acquired and developed growth of 100 plus retailers with first year's operations. He later moved on to acquisitions and asset manager vice president for Vision Properties, where he directly involved and responsible for sourcing, negotiation, and managing the acquisition of $594 million of Class A office assets. So as you see here for this quite a long bio, it's going to be a very interesting interview that we're going to have today with Anthony. But first of all, it's a pleasure to be talking with you, Anthony. Appreciate it.
Great. Thank you so much for having me.
Thank you. So again, I don't know where do we start, because I mean it's a big bio. You have a lot of experience in real estate. So maybe we can talk about your journey personally. How did you discover the real estate investing? Why did you choose this path, and how did you end up, having all these millions of dollars of assets in management?
Sure. Yeah. So to just back it up a little bit, so that bio, I should really update my bio, but no big deal because it's a little bit dated. But it paints a good picture. So the story is, I had a startup company in a different industry altogether, consumer products and retail. I stepped aside from the startup company at a certain point in time when we built it up and wanted to pursue real estate in an investment capacity, whether it was for someone else or the ultimate goal was to try to build a portfolio. So what I'm doing now is I'm the co-founder and one of the managing principals for Red Knight Properties, and we acquire multifamily and mixed-use properties that are undervalued within the tri-state area and the East Coast up and down. We have about 264 doors under management, which is about 35 million AUM, give or take, and we're mostly focused on the workforce housing segment, mostly Class B minus, C plus, garden style, walk up 2 to 3 story apartments where we can go in there and raise revenues and decrease expenses through a value add strategy. So that's what I'm up to now. So, but the background was the startup, different industry, and then I worked for another commercial real estate sponsor who focused on Class A office, as you mentioned, properties, mostly multi-tenant, investment grade assets. I was there for 5.5, 6 years. And, while I was there, I slowly bought some properties on the side and saw the power of passive income and passive cash flow. And just really wanted to take that in another direction. So that's essentially how I got started and, where I am today. Okay.
So that's kind of in a nutshell. But again, you have an experience with the Class A office, assets, and now changing a direction and going into still commercial, but multifamily, property. So why? Because again, Class A offices, I mean, they're probably in high demand because they're brand new. So you can get big companies that would pay, I don't know, again, the leasing system. Maybe you can explain that a little bit to the audience and the difference, why somebody should choose, multifamily instead of, getting these Class A office buildings.
Yeah, so it's a great question. So the thesis around pivoting to multifamily was everybody needs a place to live at the end of the day. Office, you could do very well with it. Depends where you're buying. Depends on the sub-market, micro market. Depends on the type of product, whether it's suburban versus CBD. Depends on the demand for office space versus supply. There's a lot of different factors with office. And I'm not saying those factors don't apply to apartments, but historically and from a risk perspective, I think multifamily is one of the safest asset classes, in my opinion, and the most easy to understand as well. Multifamily, storage, and industrial are kind of the three hot ones, right now. Obviously, we're coming out of the, coronavirus crisis. We're recording this in September.
Yeah.
So as you can see, the multifamily properties have been very stable for the majority of apartment owners in the country. Office buildings, people are working from home.
Yeah.
A lot of companies are leaving the city, and these are not just New York City, which is where I'm basically based, but all over the country. They're downsizing. They're trying to sublease space. They're seeing that working from home is possible. However, I do think that's going to flip because I'm reading studies where productivity has gone down, especially for employees in my age group, kind of the millennial age group. So office will come back, in my opinion, but it's a little bit more cyclical, I think, than apartments. So that was one of the reasons why I decided to choose the apartment route, especially in the workforce housing segment where, we're not buying super, super low end. We're not buying super, super high end. We're kind of right in the middle. So when you look at the last recession, which was a financial recession, this is a public health, emergency, which unfortunately caused a financial recession. But it was a little bit more forced. We would have had some sort of recession anyway because we were in somewhat of a bubble, in my opinion.
Yeah.
But we're, obviously, as you can see in the U.S., we're, our stock market's growing and the economy is getting better, unemployment's going down. So we're recovering for sure. It's still going to take a little bit of time. So I think when you look at the last recession and you look at the workforce product, you look at vacancies were very tight still. You look at rents still went up, even though it wasn't substantial, or they still went up. Property values went up a little bit. And just looking at it over the long term, I mean, for me, that just made a lot of sense. If it performed during the last recession, the next recession we're going to have, it's still going to perform. And that's what we saw. So our collections for rent over the past 5 months or so on an average basis, you're looking at 94, 95%. So that's much better than, you have an office building that's maybe 60% occupied, 70% occupied in the first place, pre-COVID. And now it's going to be 50, 40%. You might even have to end up giving keys back. Probably not, because they'll probably work out some arrangement, with you as the borrower. But to me, it's definitely more safe. It's definitely a little bit more tangible, easy to understand. The values don't fluctuate too much unless you're doing luxury, in my opinion. So, and when we stay away from the ultra luxury.
Yeah. Well, definitely makes sense, because I don't think that, like office space, like particularly Class A, brand new would be bad. But like in the times like these, you just have to pivot and kind of recalibrate your, investing decisions. So, it's good. I'm happy for you guys because you made that decision to pursue multifamily, which is like everybody needs a place to live, right? That's the main thing. And everybody can work from home. So, it's good that you're making those decisions ahead of the time, where things like that happen. Nobody planned like COVID is going to happen. So, but you're in a good position and in a really great asset class to make sure that you're going to not even going to survive, but going to thrive, even moving forward. So congratulations, on that. But you mentioned, that you're choosing kind of in the middle. So again, for the people, like, what does it mean that you're choosing, multifamily properties in the middle? Because I've seen you have all the properties that you have are currently in New Jersey, if I'm not mistaken, right?
No. So, well, yes and no. So right now we're based in New Jersey. We're about 45 minutes outside of Manhattan, New York. So properties that we have are pretty local to us. So we have properties in New Jersey. We just bought our first property in Pennsylvania, which is right over the border. And we do own a property in New York State. We are looking so that's 3 states. We are looking in other markets now. for us, it was, what I would recommend, at least what it worked for us, was to, we still property manage everything. So especially when you're, wanting to get into multifamily, or you're trying to build a track record, it might make more sense for you to property manage instead of outsource that. So we built up a management team where, we're kind of able to look in other markets now. I think it's important to diversify as well. But that's where we're based. That's where we've been focused so far. That's where we own all our units. Yep.
Okay, because like personally, like I heard that some of the states might be including, New York, it might be more kind of a tenant, friendly against of, landlord friendly. So how do you like get these, again, during times like these where people probably, you get a lot of, delinquency, like people not able to paying rent. So like, how do you handle these type of situations currently during the COVID when it comes to the tenants and, paying rents?
Yeah, so we don't open the floodgates and say, hey, if you're having problems, call me, because then every tenant will call. So we wait for them to reach out to us. Or if they're behind by, let's say they don't pay by the 10th, we'll reach out to them and see what's going on. So, what we've been doing, and there hasn't been too many. There's, like I said, the collections have been pretty strong. It's kind of similar to pre-COVID collections, maybe 1 point, 2 points less. What we've just been doing, we've been working out payment plans, mostly payment plans. So I've had some people pay, for, let's say they lost their job or whatever the case may be, half rent for, let's say, August, and then they'll catch up in September to pay everything. I've done stuff like that. You just got to be flexible. I've done weekly plans.
Yeah.
You just got to be flexible. But in terms of tenant friendliness and landlord friendliness, New York City is definitely tenant friendly. Even before COVID, we don't buy in New York City for that reason, or the outer boroughs for that reason. I also think the prices are way inflated. So that's a whole different discussion.
Yeah.
New Jersey is definitely better. Pennsylvania is definitely better. I'm not saying they're great, but they're better. So right now we're working with people, and we're not seeing too much issues. But you will have some issues with people. But it's typical. You're always going to have
Exactly.
issues
Yeah.
with renters. So.
Yeah, exactly. So when you're talking about looking for different markets, maybe you can talk just, what type of market, what type of states are you looking for to be investing in? What type of, again, asset class, because you're talking about value add property. So, but what those states would be?
Yeah. So I would say just, like I said, if there's someone just trying to start out or whatever the case may be, if where you are, if you can invest where you are, that's always the best, always. If there's other, within reason, within an hour and a half.
Mm-hmm.
It depends how big the property is. So, within reason. So, what we're looking at now, and also you just have to be educated with the other markets you're going to expand to. Like, again, I kind of had the advantage to work for somebody else. Although it was office, we were buying Florida, Maryland, North Carolina, Georgia. We were buying pretty much all over the East Coast.
Yep.
So I have exposure to these markets already. Not saying it's the same asset class, but at least I've done deals there. So those markets are very interesting to us as well. Again, it's a different beast because it's different than what you're used to. So as long as you're educated, as long as you align yourself with the right people, you have a team that you can build on, it could make sense. So, states like Florida, for example, North Carolina, we're kind of potentially looking in. So, definitely doable from the tri-state area, a quick plane ride, or you can even drive. Well, driving's a little bit worse, but you can still do it. So, but again, so you have boots on the ground, you have people that you trust. That's really what it comes down to.
Yep, definitely agree with you. And again, shout out to your partner, Brian Leonard. You know, he's, well, I just looked at the bios of yours because again, as you said, yours maybe has to be updated, but it's still, I mean, it's really impressive of what you accomplished so far, even though it needs to be updated. So I'm sure you accomplished even more, you know, during, you know, recent years. But I see that you have a bachelor's degree in applied economics and management, and I thought it should be mentioned. You know, you have that, and your partner has a degree in school management and labor relations. So I think both of your qualifications and different degrees is just matched perfectly. You know, for real estate business, and I'm sure you're doing super well with it. So, but talking about the teams, because I know your approach in the marketplace. Again, when you acquire the properties, you don't acquire these properties just for yourself, right? You make it a syndication. Is that right?
Yep.
So
Yep.
maybe you can tell people what real estate syndication is.
Sure. Yeah. So, well, we're twofold. So we do buy joint venture structures, and we do syndication. So there's a slight difference. So the syndications are basically pooling financial resources together to acquire a larger property. So, you know, we don't go and buy 5, 10 million, $20 million property with our own money. Although we invest our own money, we don't. It's not 100% our money. So usually we partner with individuals who are looking for passive income that work, you know, a W-2 job that make a good salary and have excess funds to put into another vehicle that's not the stock market, which I'm seeing a lot of people trying to get out of. So um, that's basically how we're structured. So, you know, sometimes we'll have 20, 30 different individual partners on a property, sometimes more, sometimes less. So, but they're typically 100% passive. They don't want to do anything. Obviously, we're coming in there and doing all the work, and you know, that's how we're able to buy larger deals. You just got to combine and utilize larger resources. So, and I think it's really important.
Yeah, got it. So what would it take for somebody, as it says, talking about W-2, again, kind of small business owners, like what are the regulations by the SEC? Like who is the, you know, like if can I invest with you? Like who's determining, should I be investing? Can I invest? Like what are the
Yeah.
requirements?
Yeah, no, it's a good question. So, yes, so there's SEC requirements. So, 506B is one of the syndication, you know, laws, as well as 506C. And the you could there's an accredited investor and then there's a non-accredited investor. So, SEC actually just updated their definition for an accredited investor to be a little bit more loose than what it was before. So it really depends on the opportunity. So basically the 506B states if you have a pre-existing relationship and there's certain parameters you have to meet in order to basically say you have it, if you ever get audited, if you have a pre-existing relationship, actually all of our deals have been 506Bs. So I have a pre-existing relationship. I've known these people for a while, and you could prove that. And we're not like marketing our deals. So I won't go onto LinkedIn or Facebook and say, hey, I have a 100-unit property, the minimum investment's 50 grand, here are the returns. Like I don't do that. So I usually have a small group that is already in the network that, you know, I have a relationship with that I will personally send, you know, call or email if we do have a new opportunity. Again, you can do the 506C route, which is basically you can solicit. So you can post on Facebook, you can post all over the place you want. You have to, you know, do what's called a official PPM, which is, you know, it could be relatively expensive. We still do PPMs for 506B just to cover ourselves and subscription agreements. So that's still, everything's basically the same, except that it's, you know, the 506C, if I understand, is limited to accredited investors only. Mm-hmm. So, you know, accredited investors, I think it was an income, I think it's the same, but it was an income of, if you're single, I think it was 200 a year, and or you have to be $1 million net worth, excluding your primary residence. Mm-hmm. And then if you're married, I think it was 300 a year. Yeah. And then, because sometimes you have, younger people that may not qualify for that yet, but they want to still invest in real estate. So, typically if you have, let's say you have 10 investors, you're fine with the 506B. If you have, I think it was more than 35, you have to have some accreditation for all of them, or I'm not a legal expert, but
I don't understand that.
yeah. So for us, for the most part, everybody's accredited, but it's not something that we have to verify because of the pre-existing relationship, number one,
Yeah.
And because it's not too many investors anyway. It's not over 35. So yeah, you could do it either way. I think the larger the deal, you could, you might want to do the 506C and spend the money and the resources, but the smaller the deal, you just consider doing the 506B. It's not worth the headache.
Okay, got it. Thanks for that. Thanks for explaining the differences and what is the syndication is. Again,
Sure.
for people who want to explore, again, as Anthony said, he's not legal advisor, so you should guys go and do your own research if you want to learn more, or maybe get in contact with Anthony as well and ask him the questions. But what will be the difference? Because you mentioned, again, we're talking not about big deals. We're not talking probably, 300 plus unit property. So what will be the difference, let's say maybe from the investor side, what your current investors are saying, because I'm sure some of those investors maybe owned properties themselves some time ago, or maybe they still own them, but what will be the reason behind why they choose the path and go invest with you passively? Like, what will be the difference between investor active and passive?
You said it. So, the passive, you do nothing. And, I invest passively too. So I invest if other operators have deals, I'll invest with them. It's also, you want to leverage your time. And, again, expertise plays a factor into it because, I may have someone, they want to come in and deal, and say, but they might say, oh, well, I want to be active. I said, well, you understand what active means? It means you're going to have to oversee the super, you're going to have to oversee the leasing team. You're going to have to figure out, the financing. You're going to have to figure out the equity. You're going to have to figure out the construction. Oh, I don't want to do any of that. I just want to collect the check. I said, okay, well then stay passive. And they usually say passive. So it's a job. Active is a job. So passive's not. But
yeah,
there are certain people that want to be active and want to play a role, and I always try to work that out. There's definitely a difference. So for me, if I had to, I'm a younger guy, but eventually I'll do the same thing. I'll just invest with other operators. So
yeah, it makes sense. Because again, you have these small operators out there, who own 4, 8, 16 units, and they're just like, hey, look, I'm getting more income than rather investing with somebody else passively. And it totally makes sense. Maybe that was my question, why should somebody go and invest passively and get smaller check rather than investing, themselves? But again, as you said, it's a full-time job. Like, you're going to be managing the properties. You're going to be fixing the toilets, all the problems when it comes to the management and the property. And there's so many, expenses that might not be in your business plan that might come up. So it's a very tight budget, I think, for small properties, and, for big properties and big operators, it's, easier to manage because you have a management on site, and again, you don't have the headaches, fixing the toilets and getting all the calls at night. So.
Yeah, definitely. So that's number one. I'd also say, in terms from what you just said with the returns, that's not necessarily true, in my opinion, because, for someone to own 2 family, 3 family, whatever it is, usually they're not too sophisticated and they probably bought it wrong. I've seen it happen all the time, and they're really not making much money. So again, it comes down to expertise. So if you want to invest with the right operator, they're going to know, okay, this is a good deal. I can knock it out of the park still, on the return basis. Because I've seen a lot of smaller investors just, they invest in stuff like that, and I'm like listening to some of the numbers, and like, this guy's making like 2% on his money a year. Like, does you understand that? So I would never do a deal. I make 2% of my money. Might as well buy a CD. So that's it also comes down to level of expertise and finding good value add opportunities, because I could tell you one thing, I wouldn't even buy something that's a 6% return. I mean, we're looking for like 15 plus. So that's, on the same mentality of people who think, okay, well, if I buy it myself, I can get greater return. Well, actually, I'm on the same boat. I want to get those returns too. So, that's on an IRR basis I'm talking about. But
yeah. Okay, so I'm just looking at the website, just going through the website, and I have all these questions come into my head. And what I'm seeing here, the events, tab, and like, do you have any events coming up? Maybe not networking, face to face with the social distancing involved, but maybe over the Zoom, just like this, that people can get in touch with you and learn more about what you guys are working on.
Sure. Yeah. So the best way to get in touch with me is actually if you go to our website, rentknightproperties.com. But we have a free ebook. So as soon as you go on the website, it's how to leave your 9 to 5 and reach financial independence. It'll pop up. Just put in your name and email and you'll get that. And then, what I'll do is, potentially, reach out to you or whatever the case may be and understand what your goals are. So that's the best way to reach out and to get some content. As far as events go, yeah, we do in-person networking events. We have to figure out when we're doing the next one. Probably, I don't know if we're going to have any this year, but we'll definitely have them next year, obviously. We've been doing Zoom networking events pretty much every month. And then we've had webinars pretty much every month. I think we have one on the 28th of September, another one, which I haven't marketed yet. But yeah, we're always doing something. So we always regularly have like monthly networking events and webinars, and I'll post other events as well.
Awesome. And I see that you have a podcast episodes as well dropping. It's called Discovering Multifamily with Anthony Scandariato and Brian Leonard. So make sure and go find that on iTunes. And I'm sure you guys are all over the place. But can you talk about what are you talking about on the podcast? Like, do you have a guest on, or like what's happening with this project?
Yeah, no, we have about 60 episodes so far. We try to post as many as we can, every week. But yeah, we basically discussed real estate, multifamily specifically. I've had people come on from other, asset classes and even different industries, but it always comes back to real estate. So, everything we're focusing on is building wealth, how to do that, how to achieve financial freedom, how to get passive income, and it's more of educational. Actually, it's really more educational for me. It's just like this, recording a conversation and then sharing it with the world. So it's more of an educational platform that I like to share with people. I think, knowledge is power. So.
Oh, definitely agree with you on that one. So talking about knowledge is power, for people who are watching this episode and thinking like, oh my God, Martin, you just talking about investing passively. What about me? The person who is looking to get involved, same as Anthony, maybe, creating an LLC and running, a real estate company and acquiring all these, multifamily assets. Like, where do people start when it comes to, books, seminars, mentors, events? Like, what is the first step for those people?
Yeah. Like I said, there's a lot of free resources. That's why we put out that guide on our site. Obviously Bigger Pockets is a great resource as well. There's a lot of different real estate websites, real estate books that you want to read. What I would recommend is try to figure out what part of the business do you want to be in. Do you want to set up an LLC and passively invest with other operators, or do you want to be active and try to find the property and do all the operational stuff, and find partners, etc. So because that's a business, so it's they're both businesses, but they're two separate things. So just figure out what you want to do first, and because that's pretty important. That'll kind of lead you in the direction you want to go. And then, like I said, it's always good to have a mentor. I offer a mentorship program. It's kind of new, so I only have a couple students right now, but I haven't even broadcasted it yet, to kind of get them on their feet and have them learn depending upon what their goals are. But finding a mentor and potentially partnering with them on a deal or whatever the case may be, that's um, also a good option to get started. But there's plenty of different resources. I would just say network and find someone who's doing what you want to do.
Oh yeah, definitely. You can always find people just like we connected. I think that was on
Yeah,
Facebook, right? So
yeah,
we
yeah, Mark. Yeah,
exactly just connect on Facebook. Add people, connect on LinkedIn, Facebook, Instagram, Twitter, YouTube. I mean, there's all these different sources, for the wealth of these people that you can go and tap in and get their attention for a second and jump on a call and pick their brain a little bit. But of course, at the same time, look for ways to add value to those people. But yeah, definitely, networking is a big part of this business. So talking about 2020, I mean, it's a beautiful number. It's a beautiful number, right? But the year is just a little bit turned out to be a little bit different than I thought it's going to be. And I think everybody, is just like nobody expected those things. And I'm sure before the new year, you had your own plan for the business, for what you're going to do, this year, what you're going to accomplish, which I'm sure maybe you adapted again, changed, a little bit for this year. But let's talk about the upcoming year. Let's forget about the entire COVID problems in economy, because as you said, U.S. is actually coming back slowly but surely, to the good times again. So maybe you can talk about a little bit upcoming business, opportunities, plans for the 2021.
yeah. I would say we're not done with 2020, so we're still working in 2020. But yeah, everything that we plan to do in 2020 in 2019 for 2020 materialized, regardless of all the problems, which is a good thing. Again, I told you, kind of what we're focused on, and the product type, and we fulfilled everything that we were going to, and more. So we're working on a couple things that'll probably be resolved before the end of 2020 right now. So 2020 is not over. And for 2021, yeah, we have some plans in mind already. But the year's not over. That's all I have to say. So we have 3.5 months left.
Definitely. I love your approach, and that you're saying that the year is not over, because again, for a lot of people, depending what you've been doing prior to this year, and again, it's still a good time to shift, and there's more opportunities than ever available, because the entire industries are changing, the real estate industries, businesses. I mean, everybody have to adapt and shift right now. So if you are in a right mindset and you're not complaining or have your eyes peeled open and are looking for opportunities, this is it. This is the time. So definitely, I'm on the same page with you. This is the best time ever for us also. So guys, just use the opportunities and go ahead and make it happen. So again, it's been a true pleasure to be talking with you on today. Really appreciate the time. I'm sure the audience learn some nuggets from you about what it takes to be investing in real estate actively or passively. Again, I would like for you guys to get in contact with Anthony, so maybe you can tell what will be the perfect platforms for those people to get in contact with you.
Yeah, so like I mentioned, Marty, so best way is the website and download that free ebook, so at least you have something to read. But you can find me on everything: Facebook, LinkedIn, Instagram, Twitter. No TikTok, but you can find me pretty much everywhere. Red Knight Properties is my company, or just type in my name, Anthony Scandariato.
Exactly. So, and if you're looking to learn more about real estate investing, Discover Multifamily Podcast, that's the place to go as well. So again, guys, episode 65 of Beating Alpha with Anthony Scandariato. I appreciate you guys watching the episode. If you enjoyed it, click the like or share it with a friend, and pass it on the message on what it takes to be involved in real estate, that you can invest passively, actively, and the ways you can do it. If you want to learn more, contact with Anthony, and I'm sure he's going to spare some time for you to educate about real estate investing and why is it so beneficial for you during these times. So again, I appreciate the time, Anthony. I appreciate you guys watching. I'm going to see you on the next episode.
Great. Thank you, Marty, for having me. I really appreciate it.